Hi guys, welcome back to the channel. My name is Brad. This is Firefly's Financial Toolbox. Today we're going to talk about asset allocation. Now we've talked about this in the past and everybody knows asset allocation is your personal choice on how much you want in stocks, how much you want in bonds or fixed income, how much you want in cash, and then how you break that down. So your stocks are going to be, you may have stocks, you may have real estate stocks, you may have international stocks, United States stocks. You choose to have bonds, maybe you have some CDs. All that makes up your fixed income portion. And some people choose to have cash for either dry powder to buy more stocks or just as a safety buffer in case things go sideways. Now, out there's been a lot of talk about a downturn, and I don't listen to any of it because who knows? Yes, we may have one. Nobody knows for sure when, if we do have one. So what can we do? We all know that as we get closer to retirement, we need to kind of back off on our percentage and become more conservative, right? Lots of people say 100 minus your age is what you should have in stocks, or 120 minus your age is what you should have in stocks. And I'm not really going to get into that, but it's really important that you know that as you get older and closer to retirement, you need to become a little more conservative, unless you have other forms of income. Now, for me, example, I'm going to have a pension when I retire. So I can choose to be a little bit more aggressive than I would if I didn't have that, because I can ride out a downturn a little better because I'm going to have other income. If you had rental properties, for example, that's another pretty good source of income to tide you over while that downturn's happening and your stocks are down. But most people tend to increase their fixed income to make it a little bit easier ride. And one of the tools that's really nice to check on your asset allocation is one that I use, and that's Personal Capital. Personal Capital is a website, but it's also an app that lets you and kind of keep track of everything as far as your investments, how much you're spending, and all that kind of stuff. You guys, I have a link down below, and if you use my link, you'll get $20 when you install the app and you connect an investment account. You do not have to use my link, but it's there. But today I want to talk about the asset allocation model in Personal Capital. And the reason I like it is because it gives you a little visual cue of where you're at. So if we look at mine, you guys, we can see that I'm about 56% in United States stocks. I'm about 16.3% in international stocks. Now this is of my total portfolio, you guys. I'm about 4% in real estate, about 18.25% in US bonds, less than 1% in international bonds, and about 4.75% in cash. Now, if we click on the US stocks tab, it breaks it down into the portions of where it's at, whether it's large cap value, large cap core, large cap growth, these kind of things. Has the Morningstar 9 box. So if we look at this, large cap for me is about 32% of my portfolio. Mid cap makes up about 8.5% altogether, and small cap is about 4.5%. If we look at my international stocks, we see that I'm about 4% in emerging markets and about 12.32% in developed markets. Those are big countries, big companies, right? My US bond allocation, I'm about 5.8% in government bonds, a little under 4% in municipal bonds, and about 8.5% in corporate bonds. Alternatives. Now, it breaks down as alternatives, but the bulk of my alternatives, as you can see, is real estate. That's about 4%. Another thing that's neat is if I go back to the stocks page, I can click on that and I can actually break down my U.S. sectors. So looking at my U.S. sectors, we have about 1.7% in basic materials, about 6.3% in communication services. Consumer cyclical makes up about just under 10%. Consumer defensive is about 6.75%. Financials make up about 2.64%. Energy is a little over 3%. Healthcare makes up about 12.75%. Industrials are a little over 8%. Technology is my biggest sector, you guys. It's about 19.81%. Utilities are about 2.14%, and then it has about 16.75% of unknown, which really does not classify all of it. But you guys, this is a good way for me to log on really fastly, click on the button, and see where I'm at. And then I can also use that to judge whether I'm overweighted in something or underweighted. I can also take a look at what sections have grown over time, and maybe that's the ones that I want to sell. Because remember, we always want to buy low and sell high. So I have some appreciated stocks. I can turn those into fixed assets, into bonds or into cash. Remember, if I do that in a tax protected account, a 401k, a 457, an IRA, there's no tax implications. So I can adjust that to get that asset allocation where I want it. Right now I'm sitting at about 75% stocks, 20% in bonds and fixed income, and about 5% in cash, more or less. Now, some people will rebalance once a year. Some do it on their birthday, some do it at the beginning of the year. It doesn't matter. I don't think it needs to be done more than that. But when we've had a big year like this year where tech, in 2020, tech was the big winner, right? You're probably going to have more tech stocks than you weren't. Maybe it's time to sell some of those high expensive tech stocks and buy some of the cheaper value stocks. I'm not giving you advice on it. I'm just saying something to think about. Or maybe you look at, you want it to be 70-30, for example, 70% stocks, 30% bonds. And over the last year with the appreciation, now maybe you're out of Jones. Maybe you're at 80-20. So then it's time to take some of those appreciated stocks and sell them back into your fixed income to get it back to where you want to be. You guys, everyone is different. I'm not going to tell you what asset allocation you should have. That's a personal thing. But here's something to think about. If you're somebody who got really panicked back last March when stocks started falling and you thought about selling, you're a person who should probably tend to be a little more conservative, because with more fixed income, you will lose less if stocks, for example, go down 50%. If you're 100% stocks, you guys, you could lose half. Now, if you were 80-20, the most you could lose is 40%. And that's an all-out worst case scenario, right? And I don't think that's going to happen, but who knows, right? It happened before, it can happen again. My thought is, if you have, as I said, other assets, you're going to have a pension, you have rental properties that pay you income every month. If you have other sources of income, maybe you can be a little bit more aggressive in your portfolio. But as you get closer to retirement, remember the key years are those first few years in retirement. If you retire and all of a sudden the market tanks and you're still taking out 4%, that's going to affect you a lot more long term than somebody who can either hold off or take out a little less, or who has a lower percentage in stocks because they won't lose as much. All right, you guys, hope you got something out of this. If you did, do me a favor, drop me that like. It really helps the algorithm. If you're not subscribed, go ahead and hit that red button, ring the bell. You'll get notified each time I make a video. I try to make at least once a week. All right, we'll see you. Thank you.